So at ETFGI, we've come out with a couple new reports. We recently published our institutional users of ETFs and ETP report, where we look at institutions. We were able to identify global owners of globally listed ETFs. If you look specifically at US listed ETFs, we were able to identify 56% of that ownership. There's institutions in 52 countries, 3,798 of them to be specific, and there's 7,227 mutual funds that use ETFs. And so you can look to see what types of ETFs are being used by which institution, which is really helpful from a sales and marketing point of view as a provider or bank and broker. We have recently launched an active ETF report service and another one that's looking at what's happening in the smart beta space. We've been pretty busy with some consulting projects, which are also fun, and just came back 2 nights ago from being in Hong Kong for a couple days, which is an interesting place to go given what's happened around the Chinese market, but also you have the Hong Kong Shanghai Connect, you have mutual recognition, the expectation that the Hong Kong Shenzhen Connect will be implemented at some point in the near future. And you also have discussions about passporting within different countries in the Asian region. So a lot's happening out there. Today it's a very fragmented and siloed country by country offering, but that might change as countries try to work together to take advantage of different skills and products that are available. Yeah, so I think, it's really interesting because from a behavioral finance point of view, the reaction based on the flows we see are very different. So if we looked at the flows in the month of August in US listed ETFs, there were net flows of 2.4 billion. Within that, the money was going to fixed income, and then you look at equities, and there were outflows of 6.4 billion of US listed ETFs providing equity exposure. If we move to Europe, investors in Europe put 11.2 billion of net new money into ETFs. It was our 3rd highest ever monthly inflows, and most of the money went into equities. It was going into European equities and even some into the US market. And so what that shows me is European investors are still reacting positively to ECB quantitative easing. The fact that the US economy has done well, they're confident to put money back into the US market. And if we look since 2009, there have been 20 cases of the US market declining pretty significantly. Each of them have been buying opportunities. And so for many investors who have the perspective of not being home country biased and really concerned about the US, they're able to take a more risk-on approach to investing and are putting money to work in equities and into the US market. So I think European ETFs are doing really well. Investors in Europe have found European UCITS products as ETFs are more tax efficient than US listed ETFs for most investors. The alternative fund directive makes it more difficult for US providers to come over and market and sell their products. And FATCA means investors are more inclined to use UCITS or European domicile products. So regulatory changes around the retail distribution review in the UK and in Holland has encouraged financial advisors to move from being paid to sell products to being paid for advice. And so with that change, they're embracing the use of ETFs. We're seeing ETF strategists develop. We're seeing robo-advisors. So a lot of the things that are happening in the US are migrating to Europe, and also some of them are migrating slowly out to the Asian market. So looking at things from a global perspective is very interesting. There's a lot going on in every individual market, so it keeps us very busy trying to stay on top of it.